RBI has hiked interest rates as it continues to target inflation. Now, what does this mean? That loans will get more expensive for us as commercial banks will pass on this increased rate to you and me, as the repo rate is the rate that commercial banks have to pay the Reserve Bank whenever it borrows money from it. Now, this rate has been increased by 50 basis points by the Reserve Bank of India, which has taken the repo rate to 4.9%, which is its highest level since 2020. The RBI governor flagged risks to inflation and in terms of growth. There were also risks in terms of the geopolitical tensions that we are facing and the supply disruptions. Now, coming to inflation, which matters to all of us, the hole in our pockets is going to get even deeper. The Reserve Bank of India increased its inflation forecast to 6.7% from 5.7% earlier. The Reserve Bank expects inflation to stay above 6% till December this year, that is for the first 3 quarters of this year. The Reserve Bank governor said inflation is driven by global supply shocks. The RBI also retained its growth forecast for this year at 7.2%. The RBI governor said that there are global shocks to the economy, to the global economy, but Indian economy is resilient and our economic recovery is on track. So we can see that the governor was optimistic about India's economic growth. Now let's tell you how this changes your EMIs, how the increased repo rates impacts your EMIs and when you go ahead to get a loan. Let's look at how interest rates were before RBI raised interest rates in the month of May. Remember, they raised interest rates by 40 basis points in the month of May. We're taking an example of SBI, a 50 lakh loan by SBI for a period of 20 years. Now, earlier this interest rate before the month of May was 6.65%. In June, after the first rate hike, this interest rate went up by 7.05%. Now, after this 50 basis point hike, it is expected to go up to 7.55%. Earlier, SBI completely translated RBI's interest rate hike of 40 basis points, as you can see. So, similarly, we're expecting that banks will now translate this 50 basis point hike also in their interest rate. So, this is how the interest rate will go up. Now, let's look at how your EMIs will go up. As we're assuming a 50 lakh loan for a 20-year period, earlier you had to pay a monthly EMI of 37,722 at the earlier interest rate before May, before the first hike. Then after the first hike, you had to pay 38,915. Now, after this expected hike of 50 basis points, you will have to pay 40,433 rupees. So that is an increase of over 2,000 just over this period since May. Now, let's look at how your total cost of getting a loan will increase, how the total interest you pay on a loan will increase. The total interest you paid before May was around 40,53,000, a little over that. Then after the interest rate hike in May, it went up to 43,39,000. And after this expected rate hike that we're expecting SBI and other banks to take forward of 50 basis points, it could go up to 47,03,839. So there you can see an increase of 7 lakh rupees in interest rates for a 50 lakh loan of 20 years expected. And this in fact translates into close to a 16% hike in your cost of getting a new loan. So this is why this repo rate hike matters to you. These days, we are financing everything from homes to mobile phones to even domestic goods such as food processors, and everything is financed. A lot of our products are financed. That is why this increasing interest rate will pinch us all in terms of more expensive loans.